Hello, this is Sophie Hammond and your Patton University online course instructor for this semester. This is course FIN610, Risk Analysis and Insurance. Today we're going to be in Unit 5, beginning with the introduction. Multi-risk management contracts include those intended for the reduction of risk involved with owning a home, automobile, or a business. Homeowners insurance strives to protect the homeowner against damage to the dwelling and other structures, personal property in the home, and loss of use, which protects the homeowner who cannot live in the home after the tragedy and must seek alternative arrangements. Homeowners insurance also tends to include personal liability and medical payments to those that might have been in the home at the time of the damage. Protection against earthquake, flood, or other natural disasters might be included in certain parts of the country as applicable. Auto insurance attempts to protect the owner of automobiles through personal injury, PIP or PIP, and medical payments, MedPay, which collectively provides compensation to insureds for medical expenses, lost wages, replacement service costs, and funeral expenses resulting from automobile accidents. No-fault laws suggest that benefits be paid without regard to who caused the accident. Business insurance protects firms using commercial property policy, CPP, solutions associated with direct physical loss to business property and income. Typically, there are provisions made for ensuring the different needs of each business. In this unit, we will cover all of these types of insurance as well as look at the exceptional cases. There are 3 learning objectives. The first is to compare different types of homeowner policies. The second is to evaluate automobile plans with respect to litigation and no-fault systems. And the third is to appraise commercial property insurance options available to businesses. We are now going to jump right into Objective 1 which is to compare different types of homeowners policies, with the first reading, Shopping for Homeowners Insurance. You can buy insurance for your home from many different sources, and premiums can vary greatly. As with any kind of purchase, price is not the sole consideration, but the possibility of saving 40 or 50% a year on your home insurance is worth some effort. The range of prices may not be as great where you live, but there is likely enough variation to justify shopping around. The startling difference between high and low prices clearly demonstrates that it pays to shop for home insurance. There are 3 steps to shopping for homeowners coverage. Figure out what you have, figure out what you want, and collect your quotes and information about insurers before making your final decision. These steps are illustrated in the case of the Smith family mentioned earlier in the chapter. You will need to inventory your possessions and organize all the information the insurer will need. Taking photos of your property and keeping the photos in a safe place away from your home is a good method of maintaining an inventory list. Figure 13.5, Homeowners Insurance Quotation Worksheet, shows the information about your property that you will need to provide to your insurer, including details such as construction, brick, frame, access to fire hydrants, location, age, and security. The location of the property is important and may cause you to have to pay higher premiums. The issue of redlining, higher premiums for homes in your inner cities, is discussed in the box Redlining, Urban Discrimination, Myth or Reality. Next, you will need to decide what insurance you want and the amounts of coverage. For example, coverage A, a dwelling, for $100,000, coverage E, liability, for $25,000, or coverage F, medical payments, for $500 per person. You will also need to choose your deductibles, such as $100, $250, and $500, and limits on coverage E and F, such as $100,000 or $300,000 on coverage E. Finally, collect quotes from potential insurers. You might choose a couple of online or direct mail insurers, some independent agents, and some exclusive agency companies. Taking into account any differences in coverage, compare annual premiums, and decide which company will provide what you want at the best price, as demonstrated in Case 1 of Chapter 23, Causes in Holistic Risk Management. That concludes the first reading, key takeaways and discussion questions. We will now move into Objective 1's second reading, Packaging, Coverage, Homeowners Policy Forms, and the Special Form, H03. Homeowners policies are similar to automobile policies in that they combine several types of coverage into one policy. They are a combination of property and liability insurance, along with a little health insurance for guests and resident employees. The persons insured vary from coverage to coverage and place to place. Homeowners policies are sometimes referred to as package policies because they combine different types of coverage that were previously provided by several policies and a number of endorsements. Before the availability of homeowners policies, someone trying to replicate coverage would have needed to buy a standard fire policy with a dwelling, building, and contents broad form, a personal property floater, and a comprehensive personal liability policy. In today's homeowners policies, packaging reduces costs and premiums by reducing administrative and marketing costs. It also provides broader protection and eliminates many gaps in coverage. Homeowners policy forms. First, we will look at the different kinds of homeowners policies shown in Table 13.2, Homeowners Policy Forms. Then we will examine the homeowner's special form in some detail. As shown in Figure 13.2, Homeowners Policy Structure, each policy consists of three parts: a declarations page, a homeowner's policy jacket, and a policy form attached to the jacket. The declarations page identifies the specifics that are unique to the insured, such as the covered location, and also lists policy limits, period of coverage, and the name of the insurer, and similar information. The policy jacket includes general, universal provisions, such as the title of the coverage, and acts to bind together the remaining policy parts. The policy form is the substance of the contract, spelling out the specific coverage provisions. The insured can choose from the several types of forms that are available. Following the declarations page, the balance of each form is divided into two sections. Section 1 pertains to direct and indirect property losses related to the dwelling or other structures, personal property, and loss of use. A stated deductible, $250 in most states, which can be increased, applies to Section 1 coverages. Section 2 includes personal liability coverage for you and medical payment to others. Each section lists the coverages provided, the perils insured against, and the exclusions and conditions applicable to that section. Finally, conditions applicable to both sections are listed. Table 13.3, Section 1, Homeowners Coverage, outlines the coverages in Section 1, the amounts of assurance for each type of coverage, and the perils included for the various forms. ISO forms are discussed here. Note that the limit for coverages B, C, and D is a specified percent of the amount of insurance on the dwelling, coverage A, in Forms 1, 2, and 3. Thus, when you decide on the amount of insurance to have on your house, you have automatically selected the amount for other coverages. If additional amounts of coverage are needed, they are available with payment of additional premium. Forms 4 for tenants and 6 for condominium unit owners do not cover a dwelling or other structures. The amount for coverage D is based on that selected for coverage C, personal property. The basic amount for Section 2, coverages E and F, is the same for all forms but can be increased with the payment of additional premium. The insuring agreements, exclusions, and conditions for Section 2 are the same for all forms. The basic differences among the forms are in the property coverages provided in Section 1. Forms 4 and 6 do not include insurance on the dwelling and other structures because Form 4 is for tenants and Form 6 is for condominium owners. The latter have an interest in the building in which they live as well as related structures, but such property is insured on behalf of the owner and all occupants in a common separate policy. Limited coverage for permanent appliances is provided in Part A. Form 8 is for older homes that may involve special hazards. The valuation provision used in Form 8 on the building is actual cash value, not replacement cost new. The perils covered represent another basic difference among the forms. Some are named perils while others are named open perils. Note that Form 8 has a much shorter list of perils than the others do. Special Form H03. We will examine Form H03 in some detail because it is representative of the various forms and is the most popular homeowners policy. We will, in effect, take a guided tour through the policy using the most recent ISO H03 policy form in Chapter 24, Appendix A. Our purpose is to familiarize you with its structure and content so you will know what to look for and how to find the coverages and exclusions in any homeowner's policy. Your own policy may differ slightly from the one provided in the appendix due to state and company variations. The basic coverage, however, is the same. Insuring agreements and definitions. The insuring agreements and definitions part of the policy follows the declaration page. They are the same in all homeowners forms. The insuring agreement says, "We will provide the insurance described in this policy in return for the premium in compliance with all applicable provisions of this policy." Two aspects of this agreement should be noted. First, the portion following the words "in return for" is the consideration that is vital to the contract. Unless you comply with the provisions of the policy, the consideration is incomplete. The insurer is saying, if you comply with the provisions, we will provide you with the insurance described in the policy. Second, you must look further into the policy to find out what insurance is described. Before you can determine this, you must know the meaning of the terms used in the policy. Words or phrases printed in bold letters are defined in detail under the heading Definitions. Because definitions are crucial to an understanding of the scope of coverage, these terms are listed separately in Table 13.4, Essential Policy Terms. Several other terms are defined in the body of the policy. Armed with this terminology, you are prepared to examine the following parts of Section 1. Number 1, coverages. Number 2, perils insured against. Number 3, exclusions. And number 4, conditions. Feel free to evaluate this form on your own. We will now be moving into Objective 2, which is to evaluate automobile plans with respect to litigation and no-fault systems, beginning with the only reading, the fault system and financial responsibility laws. The fault system. An issue debated extensively over the past several decades is whether or not to maintain a fault-based compensation mechanism for automobile accidents. In response to the debate, over half of the states have passed mandatory first-party benefits, also known as no-fault laws. Subject to various limitations, such laws require that insurers compensate insured for the insured's medical expenses, lost wages, replacement service costs, and funeral expenses incurred as a result of an automobile accident. These are collectively referred to as personal injury protection, PIP or PIP, and medical payments, MedPay. Under no-fault laws, benefits are provided by insurers without regard to who caused the accident. Under the no-fault concept, first-party benefits, such as PIP, are provided without regard to fault as a way to avoid legal battles. If you were involved in a multi-car accident where tort law applied, a lawsuit between the parties likely would result. The suit would be an attempt to place blame for the accident, thereby also placing financial responsibility for the losses incurred. Under the no-fault concept, each injured party would receive compensation for his or her own insurance company. There would be no need to expend resources in determining fault. Furthermore, the worry of being hit by someone who does not have automobile liability insurance would be eliminated. You already have a form of limited no-fault insurance in the coverages that compensate for damage to your car, discussed later in the chapter. The no-fault PIP or MedPay benefits extend first-party coverage to expenses associated with bodily injury. No-fault automobile laws are not uniform, yet they typically fall into three categories. Table 14.3, State Auto Insurance Laws Governing Ability Coverage, Financial Responsibility Laws, 2009, lists the laws in each state. pure no fault exists only theoretically and would abolish completely the opportunity to litigate over automobile accidents. Only specific damages, economic losses such as medical expenses and lost wages, would be available under pure no fault, but these would be unlimited. Michigan's no-fault law is closer to pure no fault than are the laws of other no-fault states. Michigan's plan, however, is an example of a modified no-fault law. Under a modified no-fault plan, rights to litigate are limited but not eliminated. Generally, suit can be brought against an automobile driver only when serious injury has resulted from the accident or special damages exceed a given dollar amount, called a threshold. For non-serious injuries, those resulting in losses below the threshold, only no-fault benefits are available. Serious injuries, or those resulting in losses in excess of the dollar value threshold, permit the injured party to take legal action, including claims for general damages such as pain and suffering. In states that adopted modified no-fault laws, as shown in Table 14.3, State Auto Insurance Laws Governing Liability Coverage, Financial Responsibility Laws, 2009, there are two types of modification. Number 1, the verbal threshold, which describes the type of injuries for which the party at fault is considered liable, as in Florida, Michigan, New Jersey, New York, and Pennsylvania. And number 2, the monetary threshold, which has a monetary limit under which no fault is assigned. When the claim is over this amount, the threshold in Massachusetts, for example, is $2,000, the at-fault system kicks in. Some states do not limit rights to litigate, but do require that insurers offer first-party coverage similar to what is available in no-fault states. An injured party can be compensated for his or her own insurer. The insurer, in turn, can sue the negligent driver. Rights to litigate are not affected. Auto plans that offer compensation to an injured motorist through the individual's own insurer are called add-on plans, or expanded first-party coverage. No fault appraised. Interest in no fault grew from the belief that the tort system is slow, erratic in its results, and expensive considering the portion of the premium dollar used to compensate persons injured in automobile crashes. If the tort system could be bypassed, all the expenses of the process, including costs of defense and plaintiff's counsel, could be eliminated. This would make more dollars available for compensation at no additional cost to insureds, and perhaps even reduce the cost of insurance. Proponents of no fault assert that money enough is spent on automobile insurance to compensate all crash victims, but that the tort system wastes funds on the question of fault. Therefore, the concept of fault should be abandoned, and the funds should be used more effectively. Furthermore, proponents argue that evidence is weak, if it exists at all, that insurance premiums actually reflect loss potentials and therefore work to defer unsafe driving. Opponents of no fault argue that it is simply compulsory health insurance with restrictions on tort action. They observe that workers' compensation was designed to reduce litigation by abandoning employers' liability, but that, in recent times, litigation in that field has been increasing. Opponents of no fault assert that many people who favor no fault do so primarily because they expect it will be cheaper than the present system, when in fact it may cost more. A study by the Rand Corporation explains that opponents to the no fault system argue that the system will reduce drivers' incentives to drive carefully, and in doing so, accident rates will increase. Financial responsibility laws. Every state has some kind of financial responsibility law that acts to induce motorists to buy auto liability insurance so victims of their negligence will receive compensation. A typical law requires evidence of financial responsibility when a driver is involved in an accident or is convicted of a specified offense, such as driving while intoxicated. The simplest way to prove such responsibility is to have an auto liability insurance policy with specified limits that meet or exceed the minimum limits set by various state legislatures. The financial responsibility laws in the various states are shown in Table 14.4, Automobile Financial Responsibility Compulsory Limits by State, 2009. Insurers and consumer advocacy groups recommend a minimum of $100,000 of bodily injury protection per person and $300,000 per accident to avoid paying from your pocket in case of liability. Several states also have unsatisfied judgment funds to provide compensation in situations when an injured motorist obtains a judgment against the party at fault but cannot collect because the party has neither insurance nor resources. The maximum amount the injured may claim from the fund is usually the same as that established by the state's financial responsibility law. When the fund pays the judgment, the party at fault becomes indebted to the fund, and his or her driving privilege is suspended until the fund is reimbursed. Financial responsibility laws increase the percentage of drivers with auto liability insurance, but many drivers remained uninsured. Therefore, about half the states require evidence of insurance prior to licensing the driver or the vehicle. Unfortunately, in many states, only about 80 or 90% of the drivers maintain their insurance after licensing. Even a compulsory auto liability insurance law does not guarantee that you will not be injured by a financially irresponsible driver. A compulsory auto liability insurance law requires automobile registrants to have specified liability insurance in effect at all times. However, numerous drivers find ways to operate motor vehicles without insurance. There are some key takeaways and discussion questions, but we will now be moving into Objective 3, which is to appraise commercial property insurance options available to businesses. Beginning with the first reading, Commercial Package Policy and Commercial Property Coverages. Commercial Package Policy CPP program was started by the Insurance Services Office ISO in 1986. Every policy includes 3 standard elements: the cover page, common policy conditions, and common declarations, shown in Figure 15.2, links between the holistic risk puzzle and commercial insurance. It is important to elaborate on the declaration page because it provides a visual aid of the various coverages that can be selected by a business depending on needs. Some businesses may not need specific parts of the package, but all the elements are listed for the choice of the potential insured. More specifically, the package may include the following commercial coverage elements: boiler and machinery, capital assets program, commercial automobile, commercial general liability, commercial inland marine, commercial property, crime infidelity, employment-related practices liability, farm liability, liquor liability, pollution liability, and professional liability. Some of these coverages were discussed in prior chapters. The rest of the coverages will be described here. Most commercial organizations have similar property exposures. Common business property exposures, along with business income exposures, can be insured through the Commercial Property Policy form of the Commercial Package Policy. The liability module of the Commercial Package Policy is the Commercial General Liability (CGL) policy. It replaced the liability coverage previously available through the Comprehensive General Liability Policy. In 1986, the CGL was made part of the new modular approach introduced by the ISO in the form of the CPP. Commercial Property Coverages. The Commercial Property Policy form of the CPP begins with property declarations and conditions. These provisions identify the covered location, property values and limits, premiums, deductibles, and other specific aspects of the coverages. These pages make the insurance unique for a given policyholder by identifying that policyholder's specific exposures. The information in the declarations must be accurate for the desired protection to exist. The remainder of the commercial property coverage consists of the following: the Building and Personal Property (BPP) coverage form, one of the 3 causes of loss forms for the BPP, Business Income Coverage (BIC or BIC form), and endorsements. Direct Property Coverage, the Building and Personal Property BPP form. The BPP provides coverage for direct physical loss to buildings and/or contents as described in the policy. Separate sections in the distinct limits of insurance are available for both buildings and contents to account for differing needs of insured. Some insureds will be tenants who do not need building coverage. Others will be landlords who have limited or no need for contents coverage. Many insureds, of course, will need both in varying degrees. Covered property. What constitutes a building and business personal property may appear obvious. The insurer, however, must be very precise in defining its intent because, as you know, insurance is a contract of adhesion. Ambiguities, therefore, are generally construed in favor of the insured. Figure 15.2, building as defined in ISO Building and Personal Property Coverage Form Sample, lists the items defined as buildings. Figure 15.3, business personal property as defined in ISO Building and Personal Property Coverage Form Sample, lists those items defined as business personal property. In addition to limiting coverage by defining building and business personal property, the BPP lists specific property that is excluded from protection. These items are listed in Figure 15.4, listed property not covered as defined in ISO Building and Personal Property Coverage Form Sample. Reasons for exclusions in insurance were discussed earlier. Note in 15.4, listed property not covered as defined in ISO Building and Personal Property Coverage Form Sample, and in the corresponding section in the policy, the exclusion of electronic data except as provided under additional coverages. In Part F, 4, of additional coverages discussed below, in Figure 15.5, the electric data that is covered is limited to a loss of up to 2,500 sustained in 1 year. The low limit on electronic equipment and data losses have propelled many businesses to buy the e-commerce endorsements discussed in Chapter 11, Property Risk Management. This exclusion is not always noticed by businesses. To ensure adequate coverage, insurers began to offer education programs to risk managers about their cyber risk exposures. Additional coverages and coverage extensions. In addition to paying for repair or replacement of the listed property when caused by a covered peril, the BPP pays for other related costs. The BPP also extends coverage under specified conditions. These coverage additions and extensions are listed in Figure 15.5. The value of these additional and extended coverages can be significant. Debris removal, for example, is a cost that is often overlooked by insureds, but can involve thousands of dollars. Recent tornadoes in the Midwestern United States caused heavy property damage, and for many insureds, the most significant costs involved removal of tree limbs and other debris. An interesting additional coverage is pollutant cleanup and removal, a provision that specifies the conditions under which and the extent to which protection for cleanup costs are paid by the insurer. Because of large potential liabilities, coverage is narrowly defined as those situations caused by a covered loss, and only for losses at the described premises. The amount of available protection is also limited. The extended coverages primarily offer protection for properties not included in the definition of covered buildings and personal property. The intent is to provide specific and limited insurance for these properties, which is why they are separated from the general provision. Newly acquired property and property of others, for instance, involve exposures distinct from the general exposures, and they require special attention in the coverage extensions. Some of the coverage extensions offer protection against loss from a short list of causes to property otherwise excluded. Outdoor equipment is an example of property otherwise excluded. Valuation. As has been discussed in prior chapters, property insurance payments may be made on either a replacement cost, new RCN basis, or an actual cash value ACV basis. If the insured chooses actual cash value, then the Provision 7 valuation of Section E, loss condition, applies. The valuation provision involves a number of parts. Part B through E explain the insurer's intent for valuation in situations involving RCN when ACV may be too difficult to measure or inappropriate. Part B, for instance, permits payments at RCN for relatively small losses, those valued at $2,500 or less. If the insured chooses replacement cost new, This optional coverage must be designated in the declarations. Further, the insured ought to recognize the need for higher limits than if the ACV is used. Typically, the insurer does not charge a higher rate for RCN coverage, however, more coverage is needed, which translates into a higher premium. For RCN to be paid, the insured must actually repair or replace the covered property. Otherwise, the insurer will pay on an ACV basis. Limits of insurance. As just discussed, you need to be cautious when selecting an amount of insurance that will cover your potential losses. The insurer will not pay more than the limit of insurance, except for the coverage extensions and coverage additions, fire department charges, pollution cleanup, and electronic data. In addition to concern over having a sufficient amount of insurance to cover the value of any loss, some insureds need to worry about violation of the co-insurance provision, which is found under Section F, Additional Conditions about the BPP. The policy provides examples of co-insurance. An example of underinsurance in the policy is provided in Table 15.1. The BPP policy continues to include a co-insurance provision as a major condition of coverage. For most insureds, however, there is a choice to override the co-insurance clause with an agreed value option, found in Section G of optional coverages. The agreed value option requires the policyholder to buy insurance equal to 100% of the value of the property, as determined at the start of the policy. If the insured does so, then the co-insurance provision does not apply and all losses are paid in full up to the limit of the insurance. The wording in the policy is shown in Figure 15.6. The agreed value option, however, does not ensure that the policyholder will have sufficient limits of insurance to cover a total loss, especially in times of high inflation. To ward off unwanted retention of loss values above the limit of insurance, the insured can purchase the inflation guard option found in Section G, Optional Coverages, which is discussed in Chapter 13, Multi-Risk Management Contract Homeowners. The inflation guard option provides for automatic periodic increases in insurance limits. The intent is to keep pace with inflation. The amount of the annual increase is shown as a percentage in the declarations. Causes of loss. We have just described some major elements of the BPP form. A full understanding of the coverage requires a thorough reading and consideration of the impact of each provision. As for which perils are covered, the property section of the CPP offers three options: the basic causes of loss form, the broad causes of loss form, and the specific causes of loss form. Causes of loss, the basic form. The basic causes of loss form is a named perils option of the commercial property policy that covers 11 named perils. See Figure 15.7. Some perils are defined and others are not. When exists, the common use of the term, supplemented by court opinions, will provide its meaning. Fire, for example, is not defined because it has a generally accepted legal meaning. Insurance policies cover only certain fires. While excessive heat may be sufficient for the fire protection to apply, oxidation that results in a flame or glow is typically required. Further, the flame must be hostile, not within some intended container. For instance, if you throw something into a fireplace, intentionally or not, that fire is not hostile and the loss is likely not covered. A review of the policy and Chapter 13 Multi-Risk Management Contracts Homeowners, where many of these same perils were discussed as they apply to homeowners coverage, may clarify which loss situations are payable on the basic causes of loss form. Review of the exclusions is just as important. Exclusions found in the basic causes of loss form can be categorized as follows: ordinance of law, earth movement, governmental action, nuclear hazards, power failure, war and military action, water damage, fungus, wet rot, dry rot, and bacteria, and lastly, other involving primarily steam, electrical, and mechanical breakdown. Most of these exclusions involve events with catastrophic potential, such as floods, the water exclusion. The reading goes on to talk about more causes of loss. Feel free to finish Objective 3's reading on your own and take a look at the Unit 5 review. This concludes our Unit 5 brief read-through.